Hi, this is JR. This is the state of the West, or my short version, meaning a summary of the state of the developed nations of the West. And this will include some ideas that will be um, startling to you, very likely. Even though you kind of know all of this, you've never heard it presented this way. This state of the West includes a declaring of a problem, an opportunity and a solution to the problem, meaning a exploration of the opportunity, basically. So note that strictly speaking, this is just one possible interpretation. There's certainly other views. This is the developed nations of the West relative to the less developed nations of the world. A lot of the references in here are to the US and Europe, the EU. I also make some references to Japan, which is a rather westernized country, even though it's not part of the West. So here's the basic point of reference. Consider that there are cycles of centralizing and radiating. Centralizing and radiating, right? In fact, both radiating and centralizing are always present. Another way to express that is that life is a process of redistributing energy towards what is adaptive. Energy could be influence, it could be affluence, it could be attention. Life is a process of redistributing energy toward what is adaptive. Whatever is less adaptive radiates its energy away toward whatever is adaptive, centralizing energy in what is most adaptive. In the economies of the developed world, I assert that there is too much centralization of influence. In other words, there is not enough radiation of responsibility. Instead, there's been a trend toward the centralization of responsibility, a trend toward the abdication of influence toward increasingly remote bureaucracies, a trend toward economic dependency. By the way, all trends begin and end as in reverse. That's why they're called trends. There are basically two ways that the trend of centralizing in the developed world could reverse. Either there can be a radiation of responsibility toward the masses of the developed world, or there can be a centralization of responsibility away from the developed world toward the developing world. In fact, those two alternatives are not exclusive. Both can happen, both a radiation of responsibility toward the masses of the developed world, as well as a centralization of responsibility away from the developed world toward the developing world. The second alternative, that one I just mentioned, is the simplest of the two. The developed world can redistribute decision-making authority for its economic activity to certain portions of the developing world, specifically the remaining primary sources of oil production on the planet, led by Saudi Arabia, the #1 producer of oil in the world, but including the various members of OPEC. For many decades already, affluence and influence has been shifting away from the developed world of the West toward the Middle East. Just as in the 20th century, affluence shifted away from Europe towards the #1 and #2 producers of oil in the world in the 20th century, the US and the USSR. The other alternative, as far as the redistributing of influence away from centralized bureaucracies in the West toward radiating toward the masses, the mainstream of people, that is actually, this will be actually the easier of the two things. The first one was simpler. This one's actually easier, like easier for the West. It's easier to have it happen quickly. It's within your influence, potentially. If you're one of the people within the West who has some of the actions and situations that I'm going to refer to, you can do the following things that I'll refer to. So the other alternative is the easiest. That is that the developed world can redistribute its centralized decision-making away from the massive bureaucracies toward the masses of the developed world. That doesn't mean it won't have some shift towards the developing world as well. That will happen. But while it may sound very attractive for the mainstream of the developed world to reassert responsibility and influence, it may be much less likely, as of right now, than a simple redistribution of influence toward the oil-rich Middle East. Why? Because the mainstream of the West has been in a trend of abdicating responsibility or influence in a few ways. There's the trend of expecting for governments to provide for the masses, whether by social service programs in general or by the latest economic rescue interventions, including the idea of political salvation provided by regulatory bureaucracies, even the Federal Reserve, a private bank. But the big examples of the trend may be more subtle. There's also the trend of the abdication of responsibility on the part of the mainstream investors in the U.S. stock market. Speculative investors have abdicated financial responsibility to huge corporate bureaucracies of professional managers like CEOs and boards of directors by purchasing shares. This is how they've abdicated responsibility, by these investors purchasing shares of major corporations without any awareness of the industry, or without much awareness of the industry, of the operations of the company, or the finances of the company. And also not an understanding of economics and the geopolitical situation of the United States as it relates to such things as oil. So, because investors have just poured money in with very little awareness, they may be surprised by things like when Enron or Merrill Lynch or AIG files for bankruptcy. The investors often did not ever know anything much about the finances of the company. They invested maybe hundreds of thousands of dollars for years. They've been invested, and they don't know really anything about the finances of the company. They don't know much about the operation of the company, like relative to other competitors, relative to other industries, relative to other nations. Like, if they're investing only in U.S. companies, they don't really know about the U.S. relative to other nations, do they? Do they? Many of them simply don't ask such questions. There's a term called due diligence, and in the case of a lot of investors, they just pour money into mutual funds or annuities or other indirect ways of owning stocks, and that is an extremely likely situation where the investors don't even know what companies they have ownership of indirectly. So these complacent investors have relied on stockbrokers and government regulators and the accountants and lawyers and the professional managers of those companies, and they're the owners of the company. These stock investors are the owners of the company, yet they've relied on other people to be responsible for the companies they own, in particular for the profitability of the companies they own. And I will make a quick note. This is really not just really naive, but really risky, but it's also a setup where creditors can come in and offer loans to these companies, AIG, Merrill Lynch, Enron. Banks within the Federal Reserve System can come in and offer loans to these companies that are not necessarily in the interest of the companies and the shareholders. But these passive shareholders, they don't know anything about the process. They're just pouring money in. The professional managers don't really work for the passive shareholders. At some point, they work for the creditors, for the Federal Reserve banks and the Federal Reserve System that is lending money to these corporations. Those are their guides. That's where their loyalty would be, is with the people who their companies owe money to, not the people who own the company. I'll make a little more divergence here, or digression here. In the case of a bankruptcy, the creditors get paid first. If a company like Enron or AIG goes out of business, the creditors get paid first. They might not get paid in full, but they get paid first before the shareholders get anything. If there's something left after the creditors are paid in full, then the shareholders have something available for them. Otherwise, the shareholders get nothing. Creditors are in the first position. They're lien holders. Legally, they have the affluence and influence of those corporations in their hands, not these passive shareholders. So the passive shareholders of the largest companies in the developed world have been speculatively investing for unearned gains through mutual funds and annuities and all these kind of things. But they do not accept or claim personal responsibility for the results produced by the businesses that they own, the profitability, the fluctuations in stock price, and so on. This includes share ownership indirectly through mutual funds, annuities, and even pensions. Who's responsible for those pensions? Well, professional managers are directly responsible, but the people who own those pensions could be the ones who assert their own influence and say, look, this is a pension fund to benefit me. I want to have some responsibility for the results of how this pension fund is managed. Most people don't say that. These shareholders, these passive owners, have abdicated financial responsibility to professional managers, whether managers that are agents of the corporation or of the regulating government, or as I also added, of the creditors that basically own the corporation in terms of huge debt obligations that the corporation has entered to these lenders. So these passive owners that have done very little, if any, research into the finances and operations of the companies they own, they tend to be surprised by crashes in stock markets and the values of their own stocks. They tend to claim that they have been betrayed by their professional managers, again, whether that's government agents or the management of the corporation and so on. And I'm not saying that they haven't been betrayed, but that as a claim is frequently made in Japan in the 90s, and in Europe last decade, in the US in the last few years. You see these kinds of claims more and more commonly are being made. These passive shareholders project responsibility for the natural results of their own speculative investing on the taxpayers, lobbying for bailouts paid for by somebody else. That's ultimately one of the most common resolutions of these kind of situations, at least in the short term. Ultimately, the taxpayers paying for all this doesn't change the valuelessness of a lot of these methods of investing, this passive investing. It's often simply these companies go bankrupt and the shareholders get very little, if anything, if they want to sell. You look at the Great Depression in the U.S., you had a 90% decline in total value of the stock market. That doesn't mean that every company went down 90% in value. A lot of companies went out of business. So let's say half the companies went out of business and half the companies dropped in value by 80%. That means the overall stock market went down 90%. You see how that would average out. Lots of companies go out of business in certain little panics and market fluctuations. So that's all passive investing. With insurance companies, yeah, it gets worse. With insurance companies, the abdication of responsibility is even more stark. Millions of people pay small premiums in order to receive huge promises of benefits from insurance companies that do not have anywhere near the funds to cover all of their promised coverage. When enough claims come in at the same time to a business that does not have close to enough money to fund all of its promises, of course, AIG could need an urgent $85 billion rescue program to continue operating. That's what happened in 2008. Again, most policyholders would express surprise to find out that the insurance company does not actually have anywhere close to the total amount of money that they have promised to pay out. Such is the state of the balance between personal responsibility and abdication into dependency, with the eventual blaming of the professional managers. Rather than a recognition by these insurance policyholders of the immense risk of their speculative investing in insurance policies, hoping that their gamble would pay off, with absolutely no attention to the financial capacity of the insurance company to eternally maintain its legalized Ponzi scheme of using new premiums to be able to afford to pay out all new claims from old policies. Note that insurance companies and insurance programs do not inherently reduce risk. Insurance policies merely transfer financial risk to someone else, the insurance company in most cases. When governments agree to be liable for risk, as in the case of the FDIC insurance program for banks within the US, that again does not actually reduce risk at all. It just transfers risk. It just means that instead of customers and the owners of the banks bearing the risks themselves, taxpayers who had no involvement in those transactions, no benefit from those business relationships, those taxpayers are the ones receiving the bills for the risk. That's what the FDIC is. And there's other examples, but FDIC is well known. The idea with government regulation and risk sharing is that governments could implement programs to actually restrict operational risk because the governments would have an interest, since they're bearing the risk, meaning taxpayers are bearing the risk. Well, the governments could implement programs to restrict the operational risk of banks. That's the idea. That's the sales pitch. While they could do that, like that's possible, government programs to manage financial risk are not always successful, as in the case of the former Soviet Union, or the savings and loan debacle of the late 1980s. By the way, the dissolving of the Soviet Union is an instance of the radiating of influence away from a centralized bureaucracy, the radiating of influence and responsibility away from a centralized bureaucracy back towards the more localized governing influences of Russia and Ukraine and Azerbaijan and all the various portions of Russia that operated independently after the dissolution of the Soviet Union. Finally, more extreme than passive speculative investing or relying on the bureaucracies of insurance companies and government regulators is the granddaddy of all risk, real estate financing. Historically unprecedented financial risks have been entered by speculative borrowers throughout the developed West, gambling on financed real estate investments, again for unearned gains. They may have been drawn in by slogans like, real estate always rises, or why rent when you can buy, or no down payment required and pay no interest for the first 24 months. Still, they gambled not only with their down payments, but with enormous amounts of credit, typically hundreds of thousands of dollars at a time. Money they didn't have, right? Similar to the whole insurance industry arrangement. Altogether, one might conclude that in the developed West, there is an unsustainable concentration of dependency on massive bureaucracies, both governmental and corporate. This includes dependencies on bureaucracies of media, education, and increasingly healthcare, but of course also pensions, annuities of insurance companies in general, mutual funds. These are all concentrations of responsibility that really constitute dependency at some point. The people that are investing in these things are saying, hey, I don't need to know anything about this stuff. Those people will take care of it for me. The professional managers, the government, the Federal Reserve, the staff down at the skyscraper. So all of those issues may be mere symptoms of the simplest issue. All of those issues of rejecting private responsibility, individual responsibility, and putting it into bureaucracies. All of those issues and all those symptoms, that could be rooted in one simple thing. The developed West has too much dependence on dwindling foreign resources, especially oil, which is the source of gasoline. So consider the example of westernized Japan, a developed country extremely dependent on foreign oil, more so than most of the EU or the US for sure. In Japan, the last 21 years have noticeably punished real estate speculators and stock market speculators for less than adaptive choices. So that's what happened. a redistributing of affluence and influence away from the less adaptive toward the more adaptive. In the case of Japan, people who saw the deflating of credit markets coming on and invested in yen, the currency. They did much better than people who were speculating in real estate, many of whom went bankrupt. I wouldn't say most, but many of whom went bankrupt, and much better than stock market speculators. The yen increased dramatically in its purchasing power of Japanese real estate, of Japanese stocks, and of most everything else. Not everything, certainly. In the last 21 years, prices of gasoline, for instance, have gone up considerably in Japan, right? But as far as I know. But certain things were less adaptive. Certain kinds of gambles were less adaptive. What some people would call a more conservative approach of having a lot of money in cash or in yen, that did extremely well. That was rewarded. Other less adaptive choices were punished, we could say. There were different consequences, different degrees of benefit, different degrees of reward. If you would say that a reward that you still have 25% of the value when you started the investment, that's what I'm calling a punishment, but what you could call it a much reduced reward relative to having the same amount of purchasing power or an increase in purchasing power. If you have only 25% of the purchasing power you did before, that's not a lot of reward. So in the European Union, the last decade has followed much of the sequence of Japan in the 1990s. After its all-time high in late 1999, the UK stock index of the FTSE or FTSE 100 plunged 50% by March 2003. So it's been about a decade since that all-time high. There's been real estate decline, a big increase in the purchasing power of the euro currency, and gasoline prices in Europe exceeded $10 per gallon in 2008 in the UK and Germany. That further, I use the word crippled, that further impacted economic activity throughout Europe, further impacting credit markets, including real estate borrowing and lending, and forcing many speculative stock market investors to sell urgently to access cash to avoid foreclosure and bankruptcy. Why? Well, after spending much more cash than they had projected on fuels like gasoline, they needed fast cash. They needed cash fast. They needed fast cash fast. And selling stocks was much faster than selling real estate. On to the US. By 2007, there was a general recognition of a notable real estate decline, which started showing up in mid-2005 in previously leading markets such as Phoenix and Las Vegas. Further, speculative stock ownership was also punished, with an 18-month decline of 56% in the US S&P 500, the 500 largest companies of the US. Note that by 2007, there was also a general public recognition that rising fuel prices were impacting the budgets and choices of most portions of the US economy, from businesses to households to governments. However, rather than retract the influence that they had abdicated to massive bureaucracies, much of the West remains invested in stock market speculation, with professional managers, responsible functionally for their financial futures, as well as continuing to gamble that real estate prices will recover. The second thing is worth a further comment. For many, their hopes in a real estate recovery and an economic recovery in general, but in particular real estate recovery, are increasingly desperate. Those hopes are increasingly desperate as their real estate has lost so much value that they might have to pay more than $100,000 of negative equity just to exit from their real estate speculations. More and more people have been exploring alternatives like bankruptcy protection and negotiated short sale of upside-down real estate. And that trend is likely to continue and even accelerate suddenly. There could be a simple solution, but how open are the people of the West to be willing to be directly responsible for taking the actions that could result in a simple solution? Okay, well, the simple solution, easy available actions within the influence of many, many people to do. Don't have to wait, don't have to rely on some bureaucrat hundreds or thousands of miles away. Here's what it is. If people are willing, people in the developed nations of the West, unless investors within the developed West are willing to reclaim financial responsibility by definitively exiting their deflating speculative investments in such things as passive ownership of stocks and finance real estate, there's little chance for an economic recovery by Japan or Europe or the US. Instead, many complacent investors of the developed West are calling for increased dependency by centralizing responsibility further toward massive bureaucracies, especially governments. This is in many, many nations. In the 90s, we saw this in Japan over and over. If that trend of rejecting responsibility continues by Western investors, speculating for passive unearned gains, and relying on other people to deliver that for them, produce those results, it may assure the rise of the developing OPEC nations into a position of being the unrivaled superpower of global affluence and influence. That's the problem, that concentration of influence in massive bureaucracies. A couple alternatives. The opportunity would be to have, for people within developed nations of the West, to reclaim their financial authority, sell those things that they have left up to other people as far as real estate market fluctuations, and the Federal Reserve should rescue me, and the federal government should rescue me, and the professional managers of the company that I invest in, they should rescue me, and all that stuff. We might even hope in the West that the OPEC nations will continue to rescue us, but in the 1970s, when you got all that oil from the OPEC nations, well, we had a lot of money to give them, a lot of affluence to give them. That may not be the case in the coming decades, years, months even. So, there it is. Act accordingly.